Hello, hello. How's everyone doing? Hey, Chris. Good to see you. Good morning, Morris. All right. So, what's up? Um, it's been a great week, and I mean, this is going to be very eventful weekend as well. We got a new president being sworn in. That's going to be great. What's the exact date? Is it Jan 10th, 20th, or is it tomorrow? Does anyone remember what's the exact?
20th, it's Monday. Yeah.
Oh, it's Monday. Okay. Anyway, Monday is holiday. So, so the stock, I'm assuming the stock market is closed on Monday.
Yep.
Okay. Cool. I know once it has happened, I think we thought the market was closed and then the market was not closed. And I only got to know like just at the end of the market when someone was sharing, hey, this is what they did. I'm like, why is the market open? Cool. All right. So what do I have for today? I definitely want to go through uh, there's a JP Morgan Asset Management, they produce a guide to the markets at the end of closer in Q4. So I was able to spend some time on it. There are almost 70 charts in it. Don't worry, I'm not going to bore you with all the 70 of them, but I picked up, the top 20, which probably makes sense for us as a retail investor. I mean, if you want to go and look at all the 70 ones you pay, but I think, so I looked at some of the 20s that I found very useful. So I will definitely want to go through that. Yeah, quick look at the crypto side. Crypto is ripping because now we have a president who's not only crypto friendly, but he is knee deep into it, he and his family. So we want to talk about that. Um, if any questions, anything else, anything, what you are watching in the markets or any other stock you want to look at or want to discuss, yeah, we'll go through that. I mean, this is for you guys. So whatever is helpful for you, we can look at it. You want to look at some stock or some specific trade, do let me know. As always, anything that we discuss here is only for education. Please don't go and trade based on whatever you hear in this session, and or for that matter, or in any other session. We should always do our own due diligence before we put any trade. Okay. Jose says, I would love to get your trade process on long straddles and strangles. So, Jose, at the outset, I actually don't do long straddles or strangles. I am mostly on the short side. Very rarely I will do long on options. In cases where I will do go long on options is mostly for, let's say, stock substitution, etc. But I don't do long straddles or long strangles because I think over longer period of time, the buying of the options doesn't work out. So,
Do you question? Do you do shorter ones, like shorter duration expiration
oh, no, no,
straddles and
no. Oh,
strangles?
sorry. So I thought you wanted long strangles mean buying the straddles and buying the strangles. I
Yeah.
I only sell. I'm mostly option seller.
Okay.
Yeah, yeah. So I
I got you. I got you.
yeah. So, but I do from a duration perspective, I'll do, more than 30 days duration, and near less than 30 days would be either trying to hedge something or trying to manage the trades.
Got it.
But mostly 99% of my trading will be just selling options and not buying. Let's look at markets quickly. So this week was pretty good. I mean, Microsoft is up 2.5%, almost 2.5%. What's happening with Apple? Apple has been, I think, consistently. Let's go to Apple chart. Let's look at Apple. Not been a great year for Apple so far, right? It's a close to it closed the year at a pretty high note, almost at 260, and since then, maybe a week before year end, it was close to 260, and since then it's been on a drawdown. So far year to date, it's down almost 5.7%, getting close to $230. So other than that, and Apple being, the biggest stock in a portfolio or in the market, S&P, I mean, it there used to be a time when market goes the way Apple goes. But at least now we have other contenders, Nvidia being the one, and I think the other companies, Nvidia, Microsoft, etc., they are holding up the market, while Apple is just not working out. Jose say Apple down because of declining market share in China and analysts downgrade. Exactly. So I think they are losing market share in China to the local players, and one of a very prominent analyst in China basically came forward and say, hey, we don't see any need to upgrade to new Apple. They don't see that people will upgrade to newer models of Apple because of Apple AI. First of all, Apple AI is not even in China. Apple AI, their artificial intelligence, is available only in English language. And the third is, even if you have Apple AI, it's not much useful. This is not an upgrade that you have been waiting for. So whole story around new super cycle, new upgrade cycle for Apple with the iPhone 16 doesn't seem to be working out. And now I already heard at least one fund manager talking about how it will be great for iPhone 17. Now they already started talking about, the 17 will be good because looks like 16 is not good at all. It says 17 will be good. So we'll see. But yeah, not been a great year for Apple. Anyway, so from a weekly perspective, I think the market looks great. All Trump, based on the Trump trade. Year to date, not that great a picture yet. I mean, we are still down from all-time high. How much down are we on SPY? So looking at SPY's all-time high was close to what, 610 or something. If you're looking at all-time high somewhere here, it's close to 610. Now within a week, we moved up from almost 575 to close to 600, but still lower than where from our all-time high. But I think the market anticipating that the future is going to be bright. We have seen estimates all the way up to 700 for the end of a year, SPY targets, and I if we had to go by predictions can go anywhere. But some analysts, they're still projecting maybe at least 10 to 15% growth on SPY for 2025. May not be far-fetched, which is going to be really great after having two consecutive years of 20% plus growth. We get another 15%, and what more do we need? But well, we'll see. Sector wise, seeing some rotation happening. Energy sector in 3 weeks of January is already up close to 10%. Now, this was one of the worst performing sector. I think two worst performing sectors of 2024 were energy and real estate, and maybe materials. But now if we look at energy and materials are two top performing sectors for 2025. Energy is up almost 9.18%. I think the crude oil hit what, more than $80 dollars per barrel, which is great. And now maybe this is a rotation happening. Financials still doing great. Financials was up almost 4%. We had a results from the big financial companies, I think all the JP Morgans of the world, Bank of America, and nothing I would say was surprising. I mean, it was a 2024 was a great year for financial sector. I think it was up even was just second or the third best performing sector after communication services and maybe information technology. Financials was either the second or the third best one in 2024. It was up more than it performed better than overall S&P 500. Let's put it that way, right? And now with the new administration, maybe it from a business wise probably it's gonna do good. Stock wise, what we don't know is how much of the growth was priced in 2024 performance itself. But so far, I mean, it's been good. And if you log in, hear any of the conference calls from um, the big banks that reported earnings this week, well, they all were very positive, all very positive, especially the ones that are more have more investment banking and corporate banking business than the consumer ones, right? So consumer ones will be like Wells Fargo, which is more consumer oriented, and let's say JP Morgan and Bank of America have more investment banking. Of course, they have a consumer also, but they have a bigger, a sizable chunk of investment banking revenue also. Now, with the more friendlier environment in 2025 with respect to mergers and acquisitions, corporate takeovers, maybe the rates could come down. We could see more offerings and more IPOs. Those investment banking um, revenue from investment banking operations should be higher in 2025 as compared to what we had over last 2 3 years. I mean, last 2 years probably was fully drought. Not big deals happening, no IPOs, not no big IPOs coming around. But now maybe next couple of years is going to be great. So I think that's the reason why we saw a lot of tailwinds in the financial services sector. Alfred says OPEX was week was fun. We saw up to 1 trillion on SPX swings during the week to rebalance. Last 5 minutes, 56 billion came in on puts and pushed the market down to its 6,000 SPX price. So was this what triple witching week? I maybe I missed it, or probably it wasn't. I thought we recently had that quadruple witching, um, but that already happened. So, Alfred, which rebalance you were talking about? Is that the S&P 500 rebalance? Okay. Jose Singh, isn't rotation into defensive sector sign of incoming correction bear market? I think it's too early to call out any rotation. We are what, just 2 weeks into it. And defensive sectors generally like healthcare um, and consumer staples, they are not doing good. So I think the fact was energy sector was so depressed um, in 2024. And I think I have a chart when we look at a JPMC. Basically, from a shareholder return perspective, if you don't look at a capital return in terms of capital gains, but the dividend plus I think free cash flow yield, um, energy was the best one. So a lot of energy companies have still been paying great dividend, but just that in 2024, overall, from a capital gain perspective, the sector didn't perform. And now, if the China starts to come back up, it's going to be good for energy, materials, and industrials. Traditionally, defensive sector, which is like your consumer staples, healthcare, they're still not doing good. Jay says, what is quadruple witching? Uh, Quadruple witching is a term that is used for an event on one particular expiration. I think it happens 3 or 4 times a year when you have a lot of stuff expiring on the same day. I think you have indexes expiring on the same day, options expiring on the same day, and then the futures options and future expiring on the same day, and whatnot. So there are four big it, expirations that come on the same day. The whole idea is doing that on the quadruple witching day. Markets could move because there's a trillions of dollars of options that are expiring, and those are expiring in futures and in options and futures and stuff like that. I don't know exactly the composite. I always go and find it and read about it, and then I forget which were the four components of those one. But that's what the quadruple witching is called. And generally on the quadruple witching day, it won't be I won't be surprised to see some big swings in the market because a lot of options and the futures are expiring on that particular day. Looking at fear and greed index, I'm surprised that the index is actually showing on in fear category. Looking at what's happening to some of the stocks, those are ripping high, especially the ones that are very, I think, prominent on the retail crowd. I thought we should be at least in neutral, if not greed. So I was surprised when I looked at, at this in the morning, like, are we still looking in a fear zone? Doesn't feel to be. I mean, you guys tell. I don't think, at least me personally, I'm not think or doesn't seem to be fearful. The market doesn't seem to me that it's in a fear state. But the way this index is calculated is looking at, how many options are bought. So there are 7 different criteria. Or maybe based on that, it shows up in a fear zone. So cautiously optimistic. So I'm always cautiously optimistic. So if someone asks me where the market is going, I think the safest answer to give is it's going up. You know why it is safest? Or any guesses? I mean, it's why it is the safest answer is to say the market is going up. Yeah, number go up. Like more often than not, market goes up. You look at last 90 plus years of data, and we'll see market has gone up 65 or 70 years of that, between 60 and 70 years. So 2/3 of the time market will go up. So if I say market will go up, I'll probably be right 2/3 of the time. Maybe I'll wrong this time, maybe next 2 times, but it's safe to say market goes up because it's more than 50% of the time markets have gone up. And yeah, cautiously optimistic. I'm always optimistic. Okay, that doesn't mean I'm gonna go all out and party as if it's never gonna end. I am a little cautious in terms of what the market have already performed in last 2 years, and how far it can go. But if we're looking at 1995, market went up like 4 or 5 years consecutively. And that time it was all about how the internet is going to change the way we live. And I think this time it is all about how the AI is going to change the way we live. But then we also know that how the story ended in 2000. Now, the answer that I don't have, the biggest question for which I'm still looking for answer is, are we in 1999 or are we in 1996? I don't think any has that
Viv-
answer. Yeah.
Vivek, uh, there was a video that I missed, but some sector of cyber is undervalued. Did you hear anything of that?
No, so what's saying like cybersecurity?
No, no, not something popular like cybersecurity, but did you hear of any sector it's cyber being undervalued? There's like 7 different categories.
No, I mean, I've not gone into, at least I've not come across a report around which sectors of the tech may be undervalued. So maybe I'm not aware.
Okay, thank you.
Mhm. But over, I mean, again, we'll only get to know whether it is undervalued or overvalued in hindsight. Right? That's the problem when you're not the problem. I think that's also the fun when you're investing in the market. Is in a hindsight we get to know, that was the top, and then we'll figure out how did we miss the top. There were signs all around, right? And but if if it continues for another 2 years, and then then we'll look like foolish. Okay, why did you get out? Market went up another 100% in 2 years. I mean, in last 2 years, what market is up 60%, 65%. Right? So we'll only get to know in hindsight. So my idea is to stay invested and just manage your deltas um, based on what you are comfortable with. Right? So nowadays, I get a little more jittery if the market suddenly goes up for no reason. That makes me scary. So if it goes up, if this year it goes up another 30%, I don't know what to say about it. Yeah. It starts to behave more like the crypto market. All right, so the next one, let's get into the JP Morgan Asset Management's guide to markets. Before that, if any other questions, anything else, any other stock that caught your attention? Trump. We will talk about Trump once we get into crypto. I I drove almost 4 hours yesterday night, and once I reached the hotel, I logged on to and I was reading Twitter. I'm like, someone made a few $100 million on on Trump coin. I'm like, what the heck is this Trump coin? So yeah, we'll talk about it, Asif. Please put the link in the chat. To know which link you're referring to. Morris, let me know which link you're telling. But this is what we want to go through. Almost close to 20 charts. The overall report had, like I said, it has 60 or sorry 70, close to 70 charts. So I looked when I was reading through all the report. I took a note of something that as an investor I would want to pay attention to. So thought I'll share that with you here. So first one is around S&P 500 valuation, right? Looking at where the current valuation is, damn, it looks pretty expensive, right? And this data is as of end of September 2024. So almost it's the end of Q3. Of course, some numbers would have changed. Right now, the PE may be close to 25. That makes it even more expensive. So from a valuation measure, forward PE, okay, so forward PE is 21. I think but that still looks expensive, right? If you go back and look 30-year average, it is close to 17. So what should we do? Damn, the P's are expensive. I'm not gonna sell my holdings right now just because the PE shows up expensive. Um, if we go back and look at you know over last 90 years worth of data, the average PE has always started to move up. So I was actually looking at some of the data yesterday. In 1880s to 1910s, the average PE was close to 13, close to between 13 and 10. And then from 1930s to 1950s, it became close to 16. And then later on it was again stayed till 16, but from 1990 onwards we bumped up, and now on an average trading close to 20. So I don't know whether I should pay a lot more attention, saying, hey, this is super expensive. Maybe the type of companies we have are different, and the way P is looked at is you don't account for any additional incremental growth, etc. So it's a backward looking measure. That doesn't mean I'm also cognizant of the fact that, hey, look at in 2000 it was close to 24x. Are we heading those peak? Maybe, may not be. But something, its market is not available at, let me put it the way that it's not available at a reasonable valuation. It's not available at a cheap valuation. It is expensive, but that does not mean that, hey, we should just sell our stocks and move on. So that's on the PE side. There's another interesting chart which tells you forward PE and subsequent 5-year annualized returns. Right. So we see. You guys able to see the Twitter post? I just want to make sure that you're seeing what I'm trying to show. Okay, cool. All right. So the second one was around where the forward PE is and subsequent 5-year annualized returns. So current forward PE at the end of September was out here close to 21. And, looking at that, subsequent 5-year return maybe around 1%, 2%, as per JP Morgan study. In fact, I think Goldman Sachs has come out and told that for next 10-year return could be 0% for 10 year. I've not looked at the study on terms of how they came up with, but when I look at this JP Morgan, they say that this is a statistical measure. Our score is 23%, which is very weak. I shouldn't even depend on this data. I don't even know why they put up this data when this particular matrix is showing up 23%. Those who are statistical oriented probably would understand. This basically tells you how much of this, the data you could actually rely upon. I can't rely on this data. This is interesting one. Next is a total shareholder yield by sector specific. Right. So this is what I was talking about. Look at energy. While the energy stocks haven't done that great, but that also means because the share price were depressed, the overall shareholder yield was one of the best ones. With include your buyback yield and dividend yield, it was close to 6.8% in 2024. Real estate also didn't do well when it comes to the capital gain perspective, but from overall yield also it didn't do well. Now this is like across all overall real estate sector of S&P 500. Now things that communication services, financials did good. In financials had a good run in terms of capital appreciation. Also, same is the case with communication services. But this was a little surprising in terms of energy from a shareholder yield perspective did really well. So that this tells us that the companies that are in energy sector, they are not bad business. They're flush with cash. They don't know what to do with the cash. So basically they paid out 7% either in dividend or by buying back their shares. That was an interesting chart. Fourth one. Right? Which is talking about relative value versus growth relative valuations. So right now, doesn't seem to be that expensive. I mean, we know the markets, all the market is concentrated in a fewer companies. Those are the growth companies. So-called value companies are not getting love from the market. The valuations are too depressed. But now looking at this chart, sure, it is not cheapest, but it is not super, I mean, not too depressed also. So a long-term average is 0.71. Right now it's 0.55. So it is the valuation of the value-based companies It is lower than what the historical has been, but you know, not as crazy what we saw during dot-com bubble. More important is also look at the different interest rate environments. So value generally perform better, which is represented in the gray bars, if you have a higher interest rate environment. And I think the reasons are very clear. The most of the growth companies, their cash flow are way out in future. When those are way out in future, then the current value, when you discount it at whatever the discount rate is, that value, the current valuation is lower. So if your interest rate goes higher, the discount rate that you apply to the future cash flows also goes higher. So then the present value becomes lower. So in a high rate environment, we will see the growth companies get hammered. That's what we saw in 2022 when Fed start to increase the interest rates, and all those high flying companies that were supposed to change the world, but 10 years down the line, not right now. They don't make any money right now, but if we can continue fund us, we will change the world 10 years hence. And those all companies got hammered because the interest rate started to go up. Now when the interest rates start to go down, that's where folks want to put money in the growth companies, because now where else are you going to put money? So looking at that, and now from basically looking at our US Treasury rates and saying from 1979 to present, the annualized total return of growth versus value. So now, if your thinking is going ahead in 2025, what do you think? Rates gonna go higher or lower? Where are rates headed?
Lower.
Lower, exactly. So that's why we're seeing a lot of growth companies, back in the market, Cathy Wood companies back in the market, and a lot of companies that retail investors love, young tech companies. They are like, they've been up, whatever, 100%. I think Robinhood is up 200 plus percent. Palantir was up like 370%. Next one, number fifth, Magnificent Seven, right? The performance of Max 7 versus the rest of 493. Actually, we should call it, because I think overall in S&P 500 there are 503 companies. If I'm not wrong, I think I read it on Wikipedia. Now take it with how much of a respect you want to go to Wikipedia, but I was surprised that S&P 500 actually has 503 companies in it. Anyway, time, that discussion we can park it aside for some other day. But looking at Magnificent Seven stocks, on the left side we see um, S&P 500 year to date, means end of September, was up 21%, whereas Magnificent Seven was up 35%. So these top 7 stocks represented green has carried the index where it is. And this also means if you're an active fund manager who's actively picking the stocks to invest in, and you did not have these Magnificent Seven, it is very, very difficult to outperform someone like you, who is a newbie and has been just buying the index fund. And now we are starting to see some reports of fund managers. They started to adjust their performance, right? Some fund managers generally don't like when the CFOs report the numbers. These are adjusted EBITDA. Right? They say, hey, what the crap is this? Why are you doing adjusted EBITDA? But now the same fund managers have started to report their performance, saying, we would have outperformed the market adjusted for not including NVIDIA. Now they are on the other side of the table, because if you have been actively stock picking fund manager and you did not have NVIDIA or some of these Magnificent Seven, it's very difficult, if not impossible, to beat the index. And now they're trying to justify why they did not beat the index. Is, hey, exclude NVIDIA and look at our performance. We're doing great. Anyway, so is it not only that the stock has performed, if you look at earnings growth, Magnificent Seven's earnings growth has been much better than the others. The one with, the other 493. The shows of all, 4 quarters. And now the profit margin, look at the profit margins. Those companies are minting money. And that's the reason why, they continuously get higher valuation. And then the concentration of these Magnificent Seven companies in the overall index continues to increase. Because S&P, at the end of the day, S&P 500 is momentum index. The higher the stock price go, the more weightage it has in the index. So yeah, before you think, oh my god, Max 7 not good, it's all been driven by Max 7 and those are insane valuation. I agree, valuations are not cheap. Well, but look at their performance. The earnings are growing at minimum 20% in 24 every quarter. Like the minimum is 20%. And their profit margins are way like 3 times higher, 4 times higher, 3 times higher than the other companies. So why the heck, market won't reward them? Jay says, need to update now to Batman. Let Jim Cramer start talking about Batman, and I think then the the other financial medias will update it to Batman. A rather interesting one. 2024, this shows the returns by sectors, if I'm correct. Yeah, energy. And then what it also shows as the forward PE ratio. Um, this is again at the end of September 2024. So from okay, so weight shows that your S&P weight, then the weight in different other, I would say, indices, Russell value, Russell 2000, quarter to date performance, year to date, a bunch of metrics. What was interesting for me when I was looking at it, there's only one sector whose forward PE is lower than the 20-year average forward PE. I think now probably is not, because now the price has gone up. Energy is up 10%, so this may not be true anymore. But compared to any other sector, this, for whatever reason, market was not willing to, or was not paying up for energy as much as it has done in last 20 years average. Yeah. All right, let's go to the next one. Seventh one. S&P intra-year declines versus calendar year returns. Right. So when we talk about that, S&P was up 24%. Everyone thinks, dude, you made easy money. Just bought S&P 500 and made easy money in 2023 because it was up 24%. But this chart shows that what you have to go through if you have to get that 24%, you have to go through the decline of 10%. And in 2024, before the end of September, market was up 21%, but at some point of a time, it was also down 8% for the year. Yeah. I saw this one 27% up. I don't know, maybe this is what year? This is probably 95, 96, 97, 98 maybe. 27% up for the year. But intra-year, it was down close to 20%. How many of us will have I mean, that's what you get paid if you stayed in the market, is you have to go through this volatility. Those who think it was a easy money to be made, it's not easy. Your stomach churns when you see your portfolio going down 5%, 10%, and you're like, gosh, maybe I should sell it and move in cash because cash won't go down. Oh, of course, these are not inflation adjusted numbers. So from that perspective, cash won't go down. So this, oh, wow, this is not easy money, let me put it that way. I'm looking at this one. Negative 34%. And probably the year ended in 16% positive. Oh, wow. This must be year 2000 or 2001. At some point of a time, you were down 30, your portfolio is down 1/3 of value, and that eventually was up 16% by end of a year. Oh, this is 2020. Oh, okay. Yeah, exactly. That was the, thanks, Alfred. Yeah, that was March 2020 when SPY was down 35% COVID. And I know some of my friends who cashed out at during the COVID time. And those were the, I mean, we didn't even know whether we're going to live or not. So the idea was to, hey, let's make sure we have enough cash cushion. And if you did not have, everything that you had was invested in the market, yeah, some folks cashed out. So yeah, it's not easy. It is simple. Investing in a market is simple, but it's not easy because you have to go through these swings in the market to get these returns of 27% or 24% or 29%. Right? So anytime when I think, hey, just invest and forget. Yeah, either you don't look at your portfolio, don't look into your log into your system to know what the market is doing, then it's fine. But now with information at our fingertips, you know, we look into our portfolio 10 times in an hour to see what's happening. So that means it's more important to be emotionally stable if you have to get the returns from market. All right, next one. Consumer Sentiment Index and subsequent 12-month S&P 500 returns. So from looking at this, whenever the Consumer Sentiment Index is at like super high, we do see that the next 12-month returns have been, let's say, negative 4.2%, negative 2.7%. It's not that it is always negative, but right now the sentiment index is at close to 70. It is high, but probably not in a bubble category. I won't call it a bubble category yet. All right, next one, track-driven CapEx spending. So when Microsoft comes along and say, hey, we're going to invest $80 billion, and then Google comes and say, and everyone's thinking, are they crazy? We got almost what $240 billion of CapEx spending, planned CapEx spending from these hyperscalers, which is Alphabet, Amazon, Meta, Microsoft, Oracle. They're gonna spend $240 billion by 2026. And say, we've never seen at such a scale. But if you look at how much money they are generating, it's gonna be what 40% of their operating cash flow. If we put it in that context, then $240 billion doesn't seem to be that crazy spending. It's like 40% of their OCF. So I think that context is important. because we never seen companies of this ilk. We still trying to think about, guys, why if you should pay so much higher valuation right now, and if our reference is still 1980s industrial companies, that's not the same comparison. These companies are spending $200 billion and it's only 40% of operating cash flow. And so that was interesting. And 10th one, CPI, and what are the components of CPI? If you look at this, the dark blue at the bottom, that shows the shelter. And right now the shelter is the biggest component, I think, followed by maybe auto insurance, or okay, with other services. I think individually, if you look at it, auto insurance and the shelter are the biggest components of inflation. And Fed can do whatever they want to, but they can't build more homes. So getting to the target of 2% inflation, unless we figure out how to build more homes, loosen some of the restrictions or give more incentives for more homes so that the shelter cost comes down, getting to 2% may be tough. Okay, next one, US oil inventories. Now this shows us the active rigs, and the gray line shows us what's our inventory level. Our inventory level is now the lowest in decades, or in last 10, 11 years. And if we are not transitioning to, green energy or alternative forms of energy, this doesn't look great for our national security perspective. So at some part of a time, we may have to refill this inventory. And that's, like it or not, our new administration is probably more favorable to drill, baby, drill. Right? So we might see more. Hopefully, this will get filled. The next one, nominal and real US 10-year Treasury yields. And this is what you get for not taking any risk, right? The easiest stuff is to go and invest in treasuries. Treasuries don't go down. I mean, it does, but you'll get your coupon rate. If you can hold it till maturity, you still get your coupon rate. But is that enough? Oh, yeah, we always need to see that coupon rate that we are getting in treasuries or any other fixed instruments. What's the spread against the inflation? Now looking at this goes till 1958. Real yields, which tells us the treasury yield minus the inflation, hasn't been that great. And most of the time it's been below 5%. And right now it is pretty close to 1% or 0.5%. Eh, So that what that means is, if we are not investing and if we are only saving, I mean, if you save it in the bank account, that doesn't give you anything. But even if we are saving in treasuries, in real life, we haven't made much of a difference because the real yield is very less. From our consumption perspective, when we won't be able to, up level our status because whatever we earned has been eaten away by the inflation. What next? Treasuries. Right? Even treasuries lose value. Even though we say those are the safest ones. I mean, your percent or coupon is guaranteed. But if you have to sell it in a secondary market, you might lose money even if you're invested in the least riskiest of instrument, which is US Treasury. And the reason is interest rates. If you bought a T-bill today, and if the interest rate goes higher next year, and if you want to sell your T-bill, you'll probably get less than what you paid for. So that basically loses its value. And longer the duration of the bond or the bill, more will be the impact. So 1% fall, or so basically this shows us how the fixed income returns in different interest rate scenarios. So if interest rate goes up a percent, your 30-year US Treasuries will lose almost 13% of its value. That's what is happening with TLT. So if we look at the TLT, ever since Fed started to increase its rates, and TLT, because it's got 20-year plus bonds, this 2020, not even here, it is 2022. Out here, yeah. TLD used to be close to 150. Nowadays trading at 80 or 90, close to 87. It's cut in half because it's a long duration bond, and longer the duration of the bond, higher is the impact of change in interest rate, both ways. So if Fed starts to cut down the interest rate, we should see more upside in TLD than, let's say, shorter duration bonds like BIL or any other um, you know treasury bills. Next one, US exceptionalism. A lot have been written about US exceptionalism in terms of, hey, US has been the best performing market. Here's some of the data. I think in 2023 and maybe in 2024, it was India and Taiwan were the only two markets that had outperformed US, including even China. That's surprising. China in 2024, at least till September, was up 29%. I noticed it only now. But looking at a 15-year period, no, it is in staying with the US market. S&P 500 has been the best over a longer duration or 15-year period than, I guess, any other one. Taiwan was second one, close to 12.3%. And I guess this is driven by mostly TSMC. TSMC is constitute a big portion of Taiwanese index, and then followed by India, which is 8.2% over 15-year annualized. So yes, US market has been exceptional because the type of the companies that we have in US. We'll have to see if this continues for 2025. All right. US market and its market concentration. So again, a lot of ink has been spilled on US market is too concentrated. But if you look at the other markets, and this chart on the right side shows you the top 10 companies, how much is the weight they have. In the US, top 10 is close to 40%. Taiwan is almost 70%. Germany, France, UK, China, Canada, a lot more concentrated than what the US market is. So it's not just a US phenomena. I think the big companies become bigger and better, that the index anyway starts to get concentrated because many of these indexes are market cap weighted. So I'm not too worried about the concentration in the US market. What I am worried about is this chart. which shows the number of listed US companies and the market cap. Ignore the market cap. Number of US listed companies have gone down from close to 8,000 in 1995-96, which is of course the peak of .com. Companies were coming to public, left, right, and center. Even if we ignore that, let's say 7,000. From 7,000 to now close to 5,500. As a retail investor who trades on the public market, damn, this is not a good news. I would want to see this number go up so that there are more opportunities that we can look at. And the reason is clear why we have fewer companies, because companies are not coming public. Now this shows the median age of the companies at IPO with every, I guess, decade. 1980 to 1989, 8 years. It takes 8 years for a company to become IPO. 1990 to 98, maybe 9 years. This was the dot-com peak. You form a company, create an LLC, and maybe in a year or two, you are in public. And now from 2001 to 2023, last 22 years, like 11, on an average, median age is 11 years. Companies are staying in the private market as long as they can. Or maybe because of it's becoming very expensive to become a public company. In terms of how many regulations you have to follow, then what you can say, what you cannot say, lawsuits, in disclosures, and everything else. So companies are taking their own sweet time to come to the public market because, hey, I can raise the funds in the private itself. They did not have a chart, or maybe I forgot if they have it, but I don't recall seeing a chart which tells us the growth of the private funding. So most of the companies still rather would sit and raise multiple rounds of funds from the VCs, or they will approach the private credit market. So the greatest example is like Databricks. Last year, I think in December or September, they had raised Series J round of venture capital funding. And if they continue the behavior, probably they'll run out of alphabets. Series J. I don't think I've seen any company raising like Series J round. And now recently, they raised another few $1 billion through private, basically debt financing as a private credit. They just don't want to go to public market. And so this worries me. I mean, all the wealth that has been created for common retail investors, we had an opportunity to participate in the growth of the companies when they were young and they became multi-billion-dollar company. Nowadays, companies like Databricks, Stripe, SpaceX is already in private markets, is already $300 billion plus company. I'm worried a little bit about this trend, that by the time the companies come to the public market, they're already very big. So companies are staying private for longer. This one, asset class return chart. Basically on the top, you have the different years, 2009 all the way to 2023. Then you have which asset classes have returned, the percent return from each asset classes. So coming to 2024 year to date, which is end of September, large cap 22%, emerging market 17%, REITs 14%. Something doesn't seem right. This is developed market 13%. I think asset allocation is 60-40, so we can ignore that. But overall, from 2009 to 2023, large cap, which is your S&P 500, is best to be in large cap across on the US side. That has returned annualized 14%. And the commodities has been I would say the worst performer. You could have just held it in cash. I think the cash they're looking at a 3-month T-bill. So that has returned on annualized basis 0.8%. So yeah, it's been almost 2 or 1.5 decades of large cap investing. Now the fact that again, when I listen to many of fund managers who have been around for many years, it used to be that you invest in small caps, which then become large cap, and so a lot of growth, it used to come from investing in small caps. I guess small caps did perform 2013, 16, 2020, but not on average. Annualized basis is the large cap which still did better. Whether we'll go back from large cap to small cap, I don't know. But that was an interesting one. And this is the most important chart, and the final one, which basically tells us the return versus the holding period. If you don't take away anything from any other charts, just look at this and say, gosh, if I'm worried about my returns, of course, if you're looking only for 1 year, 1 year, your returns, annual total returns could have been 52%, negative 37% in any given year. That's the range that we've been in. Come on, increase your holding period. For a 5-year rolling period going back to 1950 to 23, yeah, we had some years where we have a negative returns. 10-year period, you almost eliminate any chance of losing money. And 20-year, we never have had any 20-year rolling period where investing in the stock market actually lost money. That's it. Increase your, if we should have I have actually this chart printed out in my room. Whenever you feel jittery about the markets, come and look at this chart. Come on, why am I investing only for the next 1 year? Have a minimum 5-year investment horizon. Life will be okay. I mean, I'm not so special. I don't think any one of us are any special that market will do anything different just because now I am investing. Right? Going back since the market existed, increasing your holding period has always turned out to be a better strategy than trying to find out the best stock and then get in and out of it in a year or two. Yeah, so that was the last one. Any questions? I found it very, I would say, interesting. So I thought I'll share here. Anything else? You're still with me?
Yeah, I have a
Oh,
question.
sure.
What are your thoughts on Chinese stocks, the Chinese market right now?
Oh, Chinese market have been very undervalued. But if I'm investing in Chinese market, I'm keeping up my positions, managing my position size.
But you feel like it's pretty bottomed out?
it is bottom. It is very cheap in terms of the business and the valuation perspective. Stock perspective, the reason is the stock is also impacted by the other factors which are outside the business, which
Sure.
are more political, geopolitical,
Mm-hmm.
right? And I have no idea of what's going to happen. Maybe Trump will become a little favorable. I think he had a call with Xi was it yesterday or day before. He probably, if he does, work out a deal and help out China, and China helps us out, maybe then the stock will rip. But that's the one area where I don't know how to put a risk. How much, how to evaluate that risk, geopolitical risk. So my
Mm-hmm.
strategy with China is, hey, I'm gonna keep it up to a particular percent of my portfolio
Sure.
at which I'm comfortable with. So position sizing is fine. If some of the companies that I own, if those were US based companies, I would have doubled my positions in it because those companies are available at such a cheap valuation. But because it is China owned company, I'm just keeping my
Do,
position size,
do
up to.
you do you think if there is a downturn in the market in the US that money will go into China, or you think it's going to affect them negatively as well?
Oh, I don't think that it might flow to China because China is running into its own problems, right? Their economy is doing
Sure.
bad. China bonds are traded, what, the 20 or 30-year bond, they're paying what, 1.6 or 1.7% because no one is willing to buy those Chinese bonds. So they're having their own issues. So I don't think money will flow to China. It might flow to other emerging markets
Uh,
than to China or might go to developed markets, EFA.
Do you so you think you but you think it's uncorrelated still?
Sorry, say that again, was
Do
it?
you think it's fairly uncorrelated to US stocks, right?
Not sure. If a US stocks goes down, I think we will have a fear for a short term. Every market in every other
Of course. Yeah, yeah. Mhm.
might still go down because everyone
Sure.
will be afraid, and they'll move out to more of a commodity, gold, maybe holding cash. The stocks go down, maybe US treasuries will go high. The demand of treasuries will go higher. That might happen. But I don't think that people will say, hey, US market is down, so let's go and invest in China.
Okay. Thanks.
That may not happen.
Yeah, that's my question.
Uh, can I ask a question?
Sure.
So what do you think of like the AI boom and how TSM, AMD, and Nvidia will be doing in the near to far future?
So I'm not about a near what might happen in year. So from an AI boom perspective, I think 2025 may be the year when we may want to know from hyperscalers, show me the moolah. So they spend billions of dollars, and we just look at a chart and which says another $240 billion to be spent by 2026 in terms of building the infrastructure. At some point of a time, we're gonna ask, okay, you spend so much money, where's the return? And maybe 2025, I think maybe the last year when the market may be forgiving and saying, okay, go and spend it, I'm not questioning it, but I don't know how long will market continue to do it. So if we do not see the corresponding productivity improvements showing up in the quarterly results of the companies, then maybe we have one more year for the companies to just drop in AI name and get a favorable valuation. Market may run out of a patience and in giving them such a high valuation just because they are AI companies.
Mm-hmm.
Now coming to on the TSMC, AMD, I'm not sure because AMD hasn't been able to catch up onto the AI workload because they don't have a corresponding software system to go along with the chips. So I'm not sure about the AMD, but TSMC is, if I were to invest on AI basis, yeah, TSMC looks a better bet than AMD because whether it is whoever is winning the chip war, At the end of the day, the chip is being produced by TSMC.
Right.
They
Right.
will all need some fabrication plant. Intel's, they have not been able to win the customers.
Mm-hmm.
That's
Yeah.
why, that's why the not Gensler. Gensler is also out, but the Gelsinger is also out, the CEO of Intel.
Mm-hmm.
Their foundry business, I think it will be a few years, because it is not easy for any company to rip and move to a different chip provider. These big businesses are tightly integrated with their customers. So TSMC, from my perspective, TSMC will be a bet on picks and shovels rather than trying to bet on one particular company that may win AI war or AI
Mm-hmm.
war. Now, if it is a Micron, they manufacture high bandwidth memory. SK Hynix is in high bandwidth memory. These are two companies, and if we are the AI will continue, to grow, we will also have a need of a lot of high bandwidth memory to run these LLM models. But at the end of the day, the both of them use TSM to manufacture the chips.
Okay.
Right. So from that perspective, picks and shovels, TSMC, ASML, those are picks and shovels. You got other ones like LR, Lam Research, Applied Materials, all those. So that was my feedback.
Thank you.
No worries. Historically, semiconductor has been a cyclical industry. So we've seen booms and bust, or let's say booms and or the peaks and the troughs in the semiconductor company, historically. But now with this whole new AI and the new gen chip, maybe it is also becoming a secular tailwinds, not just a cyclical tailwinds. That's the additional point I want to put in, because historically this has been a very cyclical business. But maybe this time we will escape the cyclical and become more secular because of the AI tailwind. All right, Ramesh ji says Hindenburg is out of business now. Yes, Hindenburg, Nate Anderson, he wrote a final letter. You can probably see it on the website. Hindenburg. I will miss, Hindenburg and their reports. They do a very good job in terms of their short thesis. But he did put out a long note around why he is closing this fund. My main idea when I came to know about this news, not without even reading this, it's becoming very difficult to make money on the short side. You can get your rear end handed if the Reddit crowd and the Wall Street bet crowd comes against you. Right? After GME, I think many short sellers learned their lessons. So was it Muddy Water Research, who lost their shirt in the GME? Of course, there were hedge funds like Melvin Capital got destroyed because Wall Street bet crowd just killed them. So I know, I think there was Muddy Water, there was another one. A few of those short sellers basically turned into long buyers. They say, we're not doing this short selling business anymore. We're basically switching to on the long side of the house. It is becoming difficult. You have an unlimited risk if the stock continues to go high that you have shorted, and you have a limited profitability because your stock can maximum go to zero. If you're shorting a stock that is trading at $100, max you can make is $100, not anything more. The stock can go down to zero, that's it. But if the crowd comes after you, like they came after some of these hedge funds on some of the favorable names like Blackberries and the GME, it could go to whatever number. Like don't want to say infinity, but it can continue to rise, and you have an unlimited risk. So I'm not surprised that Hindenburg is saying, you know what, not really worth it. And then you get sued by the companies. You're basically fighting against some of the big corporations of the world. So, and I think there was a judgment by a US court, maybe late last year, in which the court ruled out that a company can legally go after short sellers and try to squeeze them out. And now there are things that company can do to make life difficult for short sellers. They've not done it, I think, except I know of only one scenario, which was Overstock, overstock.com. They deployed a tactic against the short sellers to basically screw them. They say, dude, you're reading a short report against my company. Here's I'm gonna screw you. And then the short sellers, got burned and they had to close their short positions. But generally, companies don't do it. But now I think one of the court has ruled that it is legal for them. So life is becoming more difficult for short sellers. But I learn a lot more by reading through the short report than by reading through long report. And Hindenburg especially has done a very good job. Their research is one of the top, one of the best research. And their track record is also good. Since you brought up Hindenburg, I think I have a chart. So let's talk about, this is the Hindenburg track record of the companies that they have short. 51 out of 63 companies now trade at a lower price than before Hindenburg created a short. So which is like 81% success rate. Which is great. But it's a difficult business. And of course, I think I don't know how much money they are making through the whistleblower reward program, but maybe not really worth it. He's been one of our more successful short sellers of recent time. But yeah, the shop is closed, and I don't know how long some of the others might stay. But it's a sad part of. I mean, it's a sad chapter. We need these short sellers to weed out the bad companies, or at least not weed out, at least let's expose the bad companies. In absence of the short sellers, Nicola can continue to roll down the truck and call it, it was driven by the battery. So, and we are, as a retail investor, have no way to figure out. We're not forensic accountants. I especially depend on these short sellers to tell or to expose the companies, or if I hold shares in the company, I will jump onto the short seller report to see what they figured out, and what are they saying about it. But now we have no one to call an emperor and say, hey, you have no clothes, which is a sad part. But it is what it is. He was a good buy, maybe not really worth to be on the short seller side. Cool. All right, let's talk about crypto. So it's a summertime. Back in crypto with a new administration, new president. I think, was it Asif who mentioned uh, about the Trump coin? Yes, the official Trump meme coin, and it is now worth $6 billion. And this is what is so crazy about it is, yeah, 5.4 billion dollars, almost $6 billion. And this damn thing was just launched yesterday, or I think at least the CoinGecko has a data from yesterday. I guess it was launched only yesterday, maybe a day before, because this suddenly blew up on Twitter saying, hey, someone bought it for spend $1 million in buying this, and now that stake is worth whatever $100 million or whatnot, some crazy numbers. So we got to be careful when we have things like these. But anyway, looking at the overall bigger market, what are we saying? Bitcoin is 104. Ethereum is kind of not doing much. It's got its own problem around what does it stand for. XRP is now at a new all-time high. There was a rumor around that the so-called strategic reserve asset might include XRP and Solana, not just Bitcoin. And based on that rumor, because right now nothing is confirmed around strategic reserve anyway, I think XRP just jumped higher, so is Solana. So XRP is hitting a new all-time high of above $3. Nothing much change on others. But overall, I think it's a positive sentiment. All the key cabinet picks, their own cryptocurrency, his own kids are very active. Um, uh, I think the Trump family had promoted a company, World Financial, and that's been basically buying and selling crypto coins and creating NFTs and all Trump meme coin. So it's a wild, wild west again. So you have to be really, really careful uh, if you are in this segment. Jose says, I think barring larger market breaking down, crypto is going to make another leg up, have potential blow off top due to Trump pump. Yeah, I mean, we haven't yet seen the big tailwinds, you know, the effect of the tailwinds to appear yet. And it might still take another year for the wirehouses to come in. And or if strategic reserve happens, I don't know where to even put this. 200K, 500K, I don't know where the limit is.
Can I ask another question?
The, sorry, you had a question?
Yeah. So you notice how on the election day it went crazy up from like about what was that, like 90 something, and then went up to like 107. Do you feel that the same thing's going to happen on inauguration, or do you think it's kind of like just mellowed out?
So I think, and I have no idea what's going to happen, right? But people more intelligent than me, they generally tell
Hmm.
what buy the election, sell the inauguration. Now,
Hmm.
I think the lot of this growth right now is based on anticipation that on the day one, he might do some executive orders
Hmm.
which are pro crypto. Some things he may be able to do, some things might need a Congress approval. So we don't know what he might gonna do, but it is based on that um, I would say probability that market is ripping higher. In a long term, I think I'm still bullish on this. Because let's say if we get repeal of SEB 121, then even your regular banks can start to engage with crypto.
Mm.
Imagine if you go log into your online banking and then you go and say, fixed instruments, buy, you get a CDs, buy bonds, buy shares. Maybe there's a tab says buy crypto. Then we talk about adoption of this, right? You don't have to open a new bank account. Most of the normies, so-called normies, yeah, they're very comfortable in dealing with their own with their financial institution. I don't want to go and open it with Kraken or whatever Coinbase stuff is. But if it's available in my bank, maybe I'll try out something. So there are many opportunities. I think it was last week or week before that, where we'd gone through coming into 2024. These were 7 or 8 items that were on my list as a tailwinds. I think we have seen only one or only two happened, which was spot Bitcoin ETF and options on it. There are other tailwinds which are still there. The impact is yet to be seen. So long term, I'm bullish on this one. I don't know what could happen in a month. It all depends on what is going to do in exactly what, which I have no insight into.
Thank you.
All right. Other big news was around the Coinbase. Now they started allowing users to take loan against Bitcoin holdings. So that means it probably could create more hodlers. Now I mean, you could always have there are other services that are available which would have allowed you to take loan against, by giving them the Bitcoin. But a lot of folks got burnt in Celsius and BlockFi and, other blowups that happened in 2022. No one want to take that risk. You can do that in Aave, you can do that in Compound. Those are decentralized ones. But then, folks just say, what, I'm not doing anything. So, but now Coinbase is a registered exchange. Now they've just launched this. I don't have the details of, I didn't even look into this to figure out, what's the percentage are they charging, what's the overall loan to value ratio they are doing, and the other stuff that we care about when you're taking loan. But my whole idea on this one is, now if someone is crypto rich but house poor, the only option to them was maybe sell your crypto and buy something else. But now you can actually take a loan against it. You don't have to sell it and incur capital gains tax. And then other question is, hey, if you think this is gonna go higher in 2 year time and way higher than what your house will be going, real estate will return. Why do you want to sell it? So if it might, make a few more folks hold their Bitcoin for longer. And I don't know if it is only for Bitcoin or other assets are, but Coinbase getting into this is a good sign. Now we have more regulated companies getting into this. This becomes more and more mainstream. It's like, hey, I'm buying a loan against my property, like HELOC. Maybe it's a BLOC. Yeah, Coinbase is the safest exchange in US. So what else? Other one, and which is around, I saw it on Twitter feed, especially after the horrible LA fires, and the whole. So the background was folks who were impacted by the LA fires, and if they're taken the self custody of their crypto assets, and which is generally by, you have a hardware wallet, you move your crypto assets from exchanges to your own hardware wallet, and then you have the custody of your wallet, you're on your own boss. But now taking the custody of your own assets also means you're also being responsible. There are some responsibilities that now you have to perform. Now in these LA fires, if someone was holding this hardware wallet and the seed phrase in their home and now they lost both, it's a game over for them. I mean, there is no way that you can recover those funds. There is no customer care to call, right? There is no company to reach out to. There is no email address. It's just like you were holding a piece of gold and you were walking across and then you dropped it wherever, or it was in your house and then it's gone. So Bruce Fenton, he wrote a few criteria saying if you are self-custodying your assets, which is what the purist in crypto economy will tell you that you should self-custody, but then you should also do this test, right? So I quickly want to go through this test in case if you are doing a self-custody to make sure, hey, are you all set? Right. So number one, tell your next of kin to retrieve your coin as if you have died. You can't give them any information right now. So if your kin can't, it means you got a work to do. They're only allowed to use the info they have right now. No new node, no new instructions. If you get hit by the bus, will your next of kin be able to retrieve your assets? But second test, put your phone down and pretend that your PC and every single thing in your home office is destroyed. That's what happened in, during these horrible fires. Now you go and retrieve your coin. Can you do it? No use of your phone or anything. Stop what you're doing and assume two or more armed attackers are now at your main premise. Assume that they're disabled the means for help, and assume that they'll find a safe if we have. How can you keep your crypto safe? Fourth, assume that over a period of 3 weeks, you will suffer from illness, amnesia, dementia, extreme trauma, which cause you to forget everything. I fell down, hit my head on the footwalk, cracked something inside my skull. I forgot everything. How do your loved ones rebuild what you had or get access to your? Well, you speak misinformation. Your political enemy are accused of a crime. The government gets a search warrant for your office, home, bank, and safe deposit box. Assume they will find any 12 to 24 word passphrase. Can an agent sweep it? And finally, you've been asked by the government to pack your bags and leave the country. Now you're living in exile. It happened on Saturday, bank is closed. Your seed phrase or your hardware wallet, which was in the safe deposit box, you don't have any access to it. You will never be able to return to your country. Can you bring your coins and access them in the new country? And that's the whole their proposition of owning crypto asset was become your own boss. You can move it across the borders. You don't have to depend on banks. A government can't confiscate it, right? But if you've not done these things or not run it through some of these tests, you can create some of your own tests. Well, then we are not doing a good job, right? And some people have learned the hard way when they suddenly realize, oh gosh, my hardware wallet got crashed and I can't find my seed phrase now. It's a toast. So I found this interesting to go through, at least think through this and say, what do I need to do? Now, there are solutions available. You can have a multi-sig, multiple signature, like 3 or 5 is needed to open the lock. So multi-sig, for those who don't know, is a process in which, let's say, that hardware wallet is signed by 5 signatures and you need at least 3 of them to open it. So if you're not around, at least the other people can open it, right? It's like a safe. It's like a safe in which 3 keys need to be inserted. And if you are hit by the bus and at least the other 4 people are there, they can still get access to it. You can have other very crude way of splitting your seed phrase into 3 or 4 parts. If I have a 24 word seed phrase, maybe do 6 words, a group of 6 words, create a 4 groups, give one group to your partner, one group to your family, brother, sister, one to friend, one to lawyer. Each individually cannot get access to the funds because they don't have the whole seed phrase. And maybe but put a, I don't know what to say, or saying, hey, in case if anything happens to me, you all 4 of you should meet together and then get access to the fund. Ideas to think about. But I think No one thinks about these things unless something happens in these LA fires. I think some folks have probably lost, and that's why this came up in discussion. Anyway, so I thought I'll bring it up in case if you are holding assets in hardware wallet, but please understand that also makes you responsible for everything that you're holding in the hardware wallet. Sridhar is asking, what is this article? I missed it. Which article, Sridhar? Talking about the test of self-custody or?
Yeah, the custody one you were just showing.
Um, uh, you can just, I think it's on Twitter, but you can just Google it, saying Bruce Fenton criteria for self-custody. It's on his website also. It's got more detail on his website.
I mean, I'm interested in learning like your option strategies, but I think that's we're going to do next week, right?
Oh, I'm just gonna talk about the ratio spread. So option strategies, I mean, there's nothing new that I do which is not available in public domain.
Mhm.
My idea on trading on options is I want to reduce the cost basis of the shares that I own. Right now, whichever way I can is that's what I'll focus on. There are very few times when I will do, if the opportunity present, when I'll do just premium harvesting. Otherwise, my idea is, hey, I own these long-term shares. Now I want to reduce the cost basis, or if I want to buy more, continue build positions. So mine would be mostly selling a covered call or selling a strangle, basically both playing on the both sides of the market. If it goes down, I'll buy more because I have a short put. And if it stays within the strike price, it reduces my cost basis of owning the shares because I retain the premium.
Are you doing the covered call and the strangle simultaneously, or just in different situations?
No, on the other side, it could be a different ticker. Let's say I'm on a stock XYZ and I've not reached the full position in that stock, right? So let's the stock is trading at 100 XYZ and I'm not in a full position. In that case, I will do a strangle on it, maybe sell a 90 and maybe 115 or 120 call. Because hey, if it falls down to 90, I'm okay to buy more because I'm not in a full position yet. If a particular ticker is already a full position of me, in that case, I might just do just a covered call because I don't want to own more shares of it. It's already part of, already reached a percent of my portfolio at which I want it to be.
And are you only selling those covered calls when it's above your cost basis, or are you okay selling it like you're not doing the wheel, right? Like
No, not always above a cost basis because then many times when the stock falls down and then you just keep holding it. But I do want to make sure that I get paid. Let's say the stock is less than, well, even I've done in a stocks with less than $5 also. But yeah, that's not a criteria that the stock has to be above my cost basis. And I know why you're asking a question is, hey, what if it gets called away? You basically logged in your losses, right?
yeah. I mean, like, because I know how to do covered calls and or sell covered call or sell covered calls and sell puts and all that stuff. But I'm trying to, optimize the best time to do it in terms of like my position and where the price of the stock is.
Yeah. So I will look at more in terms of the best time is when I look at its IV spiked up because
Okay.
then I can get a better premium. But let's say if I am scared of how if the stock goes higher and I basically get out of early, I'll do a call spread. And especially in the stocks which are more volatile, right? The ones which are on very popular among retail investors.
Mhm.
In that case, I'll do a call spread instead of selling a call against my stock holding. Because if I do a call spread, I might sacrifice a little bit of a premium, right? But what if the stock doubles? I don't want to have a seller remorse. And
Okay.
stuff like Palantir became 7x, 8x, not 8 or 80%, but 8 times. 8x in 2 years, less than 2 years. Right? So if I had just sold only a call against complete set of my holdings, I would have been taken out much earlier and I would have missed all the gains. So there are ways in which I'll optimize it, saying, hey, if I don't want to sell just a call, I might sell a call spread and
Okay.
stay in the game. Other option is I have a 400 shares, let's say, of XYZ. I'll sell a call against only 2 contract.
Mhm.
So that even if stock goes higher, I'm still in the game with the other 200 shares that I will still have. So you can look at portfolio and then devise, which you want to do.
I mean,
So,
if you do the call spread, you don't even need to own the underlying, right?
yeah, I mean, if you don't need to own. I mean, I don't have, depending on what kind of a portfolio level privilege you have,
Mhm.
you don't have to own the underlying, at all. I mean, I don't have to own underlying. I can do naked calls in any ticker I want to without owning the stock, because depending on what option level of privilege you have. But if you don't, and because the naked call selling is risky, most of the brokers won't give you that privilege, until you have had some experience, and your your account size is bigger. But then you do a spread.
Okay.
Then,
So go
so
ahead. Sorry.
yeah, so continuing on this, so then some of the stocks that I own, I will do for reduction of my cost basis. And the other is lately over the last, I would say 2, 3 years, mostly I'm focused on hedging trades, which is basically selling naked calls against XSP or
Mhm.
QQQ, SPY, just to do a delta reduction trades. Those are mostly my hedging trades.
So when you're selling options, the main criteria you're looking at is just IV spikes.
Uh, that is one of the criteria.
Okay.
So let's go. I think there are 7 or 8 criteria that I look at. And do you have access to the bootcamp videos?
I am not sure if I've seen them now.
So there are many criteria that I will look at. One is, what's my current position in the portfolio? What's the IV? How many days to expiration it is? What's the IV? Not just the IV, but the IV rank of it, and based on that is what I'll construct it. And let me just give you, okay, yeah, so I just put it on my website, optiongig.com. Come to education beginner. uh where did I cover this is the so selling put. Where's the trade entry checklist? It's an intermediate. Yeah, checklist for opening option trades, of course. So I mean,
Okay. Awesome.
yeah, so
Thanks.
in this one you can find out, I look at the liquidity, I look at bid-ask spread. Is it, there are 7 or 8 criteria I use
Mhm.
to basically before I open the trade. So I remember when I started my journey, I used to have a post-it, but then it becomes a muscle memory.
Mhm.
All right, what else? So yeah, let's address any questions, because I don't think that think or swimming is helping me today. So I'll just answer some questions and then we can call it a XDD earning any SEC reporting. Oh yeah. Oh, okay. You're looking at, yeah, some of the things that you need to check out for opening. So interestingly, since we talked about XDD, it was on a Friday. I was on Bloomberg or somewhere, and on the website, I came across a trade, and I want to seek your feedback. Have you guys gone into detail? Have you read about it? It's called Cum-Ex Trade, Cum-Ex Trade, or first I thought it was a joke. This is the one. Have you heard about this strategy? Cum-Ex trading strategy. I didn't have it. So the reason why I got to know about this was looks like one of a trader, he was sentenced or to whatever few years in imprisonment because he had exploited this and swindled some European banks out of billions of dollars. And I think the overall impact of this was almost $50 billion worth of fraud. I'm like, what the heck is this? And at a high level, they were basically exploiting a loophole in Germany tax law that if you're an institution, you don't pay basically dividend tax. They'll deduct the dividend tax, then you basically get a tax credit and they'll refund it back to you. So many of these banks, big banks, Rabobank, Credit Suisse Bank, they actually had a trading desk which would exploit this. But and one of the traders, he was he quit or let go, whatever. Then he started on his own, and of course he did some of the other illegal stuff. That's why he's in hot water to exploit it before Germany could figure out that they had paid out billions of dollars, which they should not have. A nutshell, the fact that is an ex dividend. There is a stock trades with cum dividend, which is before the dividend is paid out, and then dividend gets paid out, then it is ex dividend. And there is a time difference delay between when this happened. And there was also a time difference delay when the Germany government systems get updated in terms of who owned what shares. So they were able to exploit in a way in which some of the traders will move the shares among themselves and were able to claim the refund twice. So the when a trader gets a shares and when they receive a dividend, the German government will deduct the dividend paid by the German company and it goes to the German treasury. But the trader receives a certificate which says so much tax has been paid. They can use a certificate and get back the tax that have been paid because they are institutions and they're exempt from a dividend tax. But using this Cum-Ex trading strategy, somehow they were able to get two certificates presented to the German government, and they had exploited this like over years. Now it's not only German government, looks like any some other government also had this stuff, and it's almost $50 billion worth of fraud before they figured out, and then they closed this loophole of on this Cum-Ex trading strategy. But very interesting stuff. I don't think we get exploited, but just from a learning perspective, how the system works would have been an interesting read. Trading around dividends, yes, Sridhar. Is this legal? It was legal, and that's what the traders say. Hey, guys, we just exploited this loophole. But I'm sure other legal luminaries have a different viewpoint. Anything else? Thoughts on CRM? CRM has been on fire only because of the whole agentic AI. Right now, agentic AI is hot, and the Salesforce, Mark Benioff, he sells it like, I mean, he's a great salesperson. On any call, any analyst call, he will sell his agentic AI version. I think they call what Agent Force. Again, like all other, I would say, AI products, we have yet to see in terms of how many customers deploy it and actually reduce the cost of it. But I think for now the tailwind is behind agent AI, and from that perspective, I think CRM is doing good. I think anything related to the AI, we have yet to see. It's right, it's all based on the promises. Look at Microsoft. Microsoft is now, they have rebranded their Copilot to Copilot Chat. We had a promises of AI laptops. I don't see AI laptops like selling like hotcakes. I don't even think that AI laptops, the availability on AI have increased the sales of a laptop. Hasn't panned out. But AI laptops used to be the thing that we talked about in 2023. It's going to be next super cycle. Everyone would want to have an AI laptop. That didn't pan out. But once the infrastructure is built, we have yet to see how many companies are actually benefiting from AI. I know Goldman Sachs is the CEO came and told, right, for creating an S1, they used to put 3 junior bankers for 6 weeks. Now the AI can do it in a few hours. And then why do you need those 3 junior bankers? You can have an AI create your S1 document, a senior banker will review it. That, of course, that's a productivity gain. Yeah, you feel bad about the junior bankers who gonna lose their job. But hey, you gotta learn how to use the new tools. There was an interesting chart around recent MBA graduates from Harvard, MIT, Stanford, maybe UPenn. I mean, the top schools of the world. And the percentage of students who have not been, the percentage of graduates, MBA graduates who have not been able to get the job 3 months after the graduation. First of all, it seems to be, come on, the Harvard MBA grads can't find a job. Or maybe the job that they really want to do. A lot of these middle management is getting replaced by AI. So the typical job of a middle management would be to consolidate, filter the information, make sure you're taking care of all the glaring errors before you pass it on for consumption. Now AI can do all that stuff. So why do you need middle managers? I think Meta is firing another layer of managers. So yeah, so those MBAs are now finding it tough. Ramesh says, I heard some about junior coder AI replacing them. Correct. You don't need so many junior coders anymore. The skeletal code can be written, and then maybe a senior developer can review it and make changes. So we are in a strange phase where the new technology is changing how we operate, and always happen with the new tech that some folks will lose their means of livelihood, but then new jobs get created. Has happened for decades, for ages. Candlelight makers, I would say horse carriage drivers, steam engine drivers, you get replaced by others. Alfred Rout, now many are getting certificate classes of AI. Major changes coming up. Microsoft have a leg up on the future. True. Microsoft with OpenAI, I'm a little concerned around OpenAI. Otherwise, Microsoft is a great company. My only question is around that OpenAI. Work on assembly or building home is safe to earn a living. The things that you can do with your hands, we don't have those human and robots who can do everything. So yes, there is a lot of discussion among even the tech circles. The VCs, the use of the trade school. Instead of going to a traditional school to get a degree in which you do the work which AI can do, maybe going to a trade school is a better option. AI can't replace a plumber to come and fix the leaking pipe in my house. The person has to come and fix it, right? I can't depend on Copilot for that. Anyway, yeah, it doesn't. It's not good for the people who are impacted by it, but every technology goes through the same stuff. When we got computers, we replaced human computers. Right? So those folks whose job was to calculate and compute, they lost their jobs because we got computers. But yeah, so it's gonna change. Now the question is, how much is the hype? How much is actually productivity gain? There was a chart that I had on productivity gain. Hold on. Yeah, I think, yeah. So this is a chart I had on productivity gains. Yeah, I'm still sharing my screen, right? So why AI stocks, her productivity has stalled since early 2000. So we had a cloud services, right? And then between over here, it's almost moving on the sideways, right? I think the huge productivity gain came in when the PCs got introduced. Now 94, 95, internet, mobile, now moving to cloud. Now we are moving sideways. Now with the AI, maybe the whole hope is we're gonna get another round of productivity gains. And that's why AI stocks are so hot. But that's on anticipation. One thing is also, I think Salesforce has mentioned that they're not going to hire any more software developers. On the other side, they're going to hire 2,000 salespersons to sell like agent force. So there was a meme going around. Can't your agent force sell themselves? You need a sales people to sell those agents who will do the selling for your customers. Cool. All right. Thank you, everyone. And I will talk to you next week. Bye-bye.